Here is a number that should not exist yet. In its very first full year, a challenger's brand new data center graphics chips did more than $5 billion in revenue, starting from almost nothing. And that happened inside a market where one rival controls somewhere north of 90% of every AI accelerator sold. That is the whole setup. The giant cloud buyers quietly want a credible number 2 because a second source disciplines price and protects supply. AMD has built the fastest product ramp in its history straight into that gap. So the question this episode audits is simple. Is the number 2 actually taking share or just riding a rising tide? No buy call. Start with the ramp itself because it is genuinely impressive. The generational cadence is real. From the first Instinct chip with 192 gigabytes of memory to the next with 256, to a new architecture, to a full rack scale system, roughly 1 launch a year. That is execution. But now, put it on the same chart as the leader. Line the 2 revenue lines up and the challenger's bar barely lifts off the floor. Its slice of data center GPU dollars still reads low single digit, somewhere around 4% by the run rate. So here's the tension. A credible number 2 in a market that wants one should be capturing double-digit share by now. The ramp is fast. The share bar is not. Selling more chips is not the same as earning more. Walk the segment from revenue down to operating profit, and the second problem shows up. The challenger's data center operating margin sits somewhere in the mid to high 20%. Call it 25 to 29. The leader's data center line earns north of 60. Same end market, roughly half the profitability. Why? Because a number 2, by definition, sells at a number 2 discount. It has to price under the incumbent to win the socket, and a strong corporate gross margin near the low 50s gets dragged down on the AI line. So the revenue ramp is real, but every dollar of it converts to thinner profit than the leaders. Volume is not the same as margin. Here is where the future actually lives. The upside case for the challenger is not really a hardware story. It is a software story. The leader's moat is its programming ecosystem, with something like a 15-year head start that every framework was built around. The challenger's answer, its open software stack, has to keep lighting up support. The training framework, the serving libraries, the compilers, one piece at a time. On paper, the hardware competes hard. More memory per chip, a strong rack-level cost story. But forward estimates only keep rising if that software gap keeps narrowing. If it stalls, the revisions stall with it. So the entire bull case rests on a moat closing that took the leader a decade and a half to build. Now the honest other side, the scenario that would break the thesis. The buyers want a second source, but nothing says that second source has to be this company. The same giant clouds are pouring money into their own custom silicon. The in-house training and inference chips they design with the big merchant silicon houses. If the demand for a number 2 routes into those internal chips instead, then the challenger does not become the durable second source. It stays a swing supplier, bought when the leader is sold out at a discount and dropped when supply loosens. So the real contest is not just against the leader, it is against the buyers building their own number 2. That is the branch that would falsify the take share thesis. So weigh it. The bear case, share stays flat. The discount persists, and the ramp is just a rising tide. The base case, steady, low double-digit share creep, real but slow. The bull case, the software inflicts, and the rack economics start winning whole data centers. Now line those against the price. The stock already trades at a forward multiple in the 30s to low 40s, which means a good amount of future share gain is baked in before it's proven. Put the ramp, the discount, and the software moat together, and the read is not broken, but it's not confirmed either. The room for a number 2 is real. The evidence that this company is taking it is not yet. Back to where we opened. $5 billion of revenue from almost nothing into a market one company still owns. The room for a number 2 is real. That was never the question. The question was whether this challenger is the one taking it. And on today's evidence, the answer is not yet. The verdict is stretched. Here is the single metric that would flip it toward intact. Watch the data center GPU run rate and the estimate revisions together. If the quarterly run rate keeps climbing and forward numbers keep getting revised up, the share story is finally showing up. If they flatten, it was the tide. This is educational analysis of a mechanism, not investment advice. Do your own work before acting on any of it.